This conference will now be recorded.
Hello, everyone. I'm Tanya Medgarden. I'm one of our credit union principals based here in the Midwest. And today I wanted to share some information with you about credit union tax implications. So let's get right into it. First of all, we're going to start with a disclaimer. And again, the information here, you can read it, but we're not giving legal, accounting, or tax advice or opinions at this moment, so make sure you consult your CLA contact or your other tax professional before you actually would take action based upon this information. So we're going to cover a lot of items today at a pretty high level, but we're going to start out with just the basics of credit union taxation. So to start out, credit unions are typically a federal charter or a state charter, and if there's a federally chartered credit union, they're exempt from filing the 990s and 990Ts. So therefore, they do not pay tax on their unrelated business income. So that is one of the, benefits of being a federally chartered credit union. For state chartered credit unions, they are exempt from regular income tax on earnings and profits, but they are taxed for those portions that are non-exempt. So they do pay unrelated business income on those items that are not a part of their exempt purpose. So as far as those state chartered credit unions go, they're required to file the 990T if they have 1,000 or more of unrelated business gross income. So again, that's gross, not net. So if you have $1,000, for example, of non-member ATM fees, then you would need to file the 990T. So again, based on total revenue and not the net. And the filing is required even if you have more expenses than you have revenue. So if you end up with a deficit, you would still be required to file if you did meet that $1,000 or more threshold of gross income. Various states also have 990T filing requirements. So you'll want to also check your state requirements and make sure that you're meeting all of the filing requirements that you are under. So let's talk about some of the common sources of unrelated business income for credit unions. The biggest one we see most often is those non-member ATM fees. So you have an ATM out there and you have people that use it besides just your membership. Those fees that are earned from the non-members are definitely subject to UBI. Automobile warranties is another area that would be subject to the unrelated business income tax, and certain insurance products. So AD&D, life, health, or cancer, all of those insurance sales are subject to UBI. For credit, life, and disability or gap auto insurance, those would be subject to UBI only to the extent that they apply to non-members. So if you're offering those services to people outside of your credit union membership, those would be subject to UBI. Income reported on S-Corp K-1s can be applicable too. So if you're getting a K-1 and that is not related to your exempt function, those potentially could be sources of UBI also. And really, any other income that's not related to the exempt function of the credit union could also fall under UBI. So if you have some other things that you're concerned about or wondering about, definitely reach out to your team at CLA and we will help you decide whether or not those should be subject to unrelated business income. So we had the Tax Cuts and Jobs Act that came out fairly recently, and it did create some changes in the tax specifically related to credit unions. So let's take a look at some of those areas next. The first piece we're going to talk about is trades and businesses and NOLs. So as we previously did the 990Ts, anything that was unrelated was lumped together. So you would combine your non-member ATMs, your warranties, all of that was combined into one 990T. With the Tax Cuts and Jobs Act, we now need to silo those, and so they're reported separately. So you will have a separate form for your non-member ATMs, a separate form for your warranties. So each of those is siloed separately. And that creates another problem as well, because previously if you had losses in one business, you could offset those if you had income in another line of business. But with this new tax law, only the losses from one activity can only be applied to that same activity. So you cannot use those losses to offset gains in other activities anymore. So that is a change that happened with this. Not only are they reported separately, but those losses can only offset the same type of income. And the $1,000 threshold applies to the combined gross income. So you could have different types of unrelated business income, and if together that gross income number is over $1,000, that's when you need to make sure that you're doing this filing. So if you did have net operating losses that were from previous to 2018, those obviously were not required to be segregated and only used for a certain purpose. So those pre-2018 NOLs can still be applied to any unrelated business income activity. So those didn't fall under the siloing rule, so those can be used to offset any income at the current time. But for 2018 and future NOLs, those are the ones that now can only be allowed for the activity where the income loss was generated. So again, they're siloed. You can't offset, for example, ATM income against warranties. They can only offset the type from which they originated. And so if there's not any future income from that activity, if you don't anticipate there will be income, then those losses just would not be usable. And they also cannot be carried back to prior years. So there's definitely some changes in the way that these are reported and the way that they're able to be applied. So from a planning consideration, we're looking for more transparency in the calculations through these rules. So the IRS will now be able to much more clearly see what activities that you're doing that are unrelated business income and what the income and expenses of each of those activities are. And so it could result in an increased risk of audit because they're going to just have a lot more access to information than they had previously when everything was just lumped together. So one thing we want to caution people of is the perpetual losses. So if you have those NOLs that you're generating, they can't be used anymore to offset other activities. So there's not, a big incentive to really generate those. And the IRS also has an assumption that you wouldn't continue to engage in activities that would continually lose money. So you want to be careful about showing these large losses and instead want to make sure that your expenses reflect the true economics of the activity. So if your direct losses take care of that income, you may not need to go the extra step of allocating a lot of indirect costs as an example. But again, just don't want to put yourself in an area where you might trigger audit or have a difficulty defending your position. So just be careful with those perpetual losses with these new rules in place. As far as allocating expenses go, any expenses that are directly connected are definitely fully deductible, so you'll want to make sure you take those. A couple of examples are listed here. If you are paying commissions to employees for selling their AD&D insurance product, for example, those would definitely be deductible. If you're paying Brinks fees for your ATM cash delivery, those are definitely direct costs. Those are definitely deductible. And ATM-related direct expenses should be allocated based on the percentage of your total non-member transactions where a fee is earned. So when you have those statistics from your ATM, you can calculate that percentage of your total non-member transactions and allocate those ATM fees accordingly. And lastly, there are indirect expenses that you can take that can be used for your exempt function. Those would include things like salaries, your overhead, some actual physical space costs. And again, we just recommend those be allocated on a reasonable basis. So again, no need to generate those large NOLs if they're not going to be of value to you in the future. But again, just take a look at those expenses and make sure that they're reasonable. Another new item with the Tax Cut and Job Act was the transportation and parking benefits. So there were some larger changes here that we want to cover on too. So for-profit entities with this rule, those transportation-related fringe benefits are no longer tax deductible. So for nonprofits, that also created unrelated business income under this new rule. So those are reported on a new line on the Form 990T. And you can see some of the examples listed on the slide here. The biggest one we're seeing the most often is the parking reimbursements for employer lots or commuter lots, or free parking in employer lots. So there are some of these items that will create additional UBI that was not previously reported as UBI. So qualified parking, what is that? That would be parking that's on or near the business premises of the employer or on or near a location from which the employee commutes to work. So those parking items that you're provided that meet that criteria would need to be taken a look at. There's also something within the new standard that takes a look at the on-premises athletic facilities that would include gyms or athletic facilities. So if you have provided those types of benefits to your employees and they're located on the premises of the employer, they're operated by the employer, and substantially all of the use is by employees, their spouses, and dependent children, that can be another case that creates this UBI. So for parking calculations, the IRS did issue a notice 2018-99 that clarified the amount of the parking expenses that are subject to tax. So the taxable benefits do include those facilities that are owned or leased by the employer, and there can also be cases where the employer pays a third party for employee parking spaces that can also create UBI. So the calculation in the COT, it really is based on the cost of the parking or the parking facilities and not the value of those. So when we're looking at this calculation for UBI, the costs that we're including are things such as listed there: repairs, maintenance, utilities, insurance, property taxes. You'll see all of those types of expenses are things that you'll want to include, and depreciation is not required to be included. So as far as lease spots go, lease spots are always included in UBI, and the limit on an employee's monthly exclusion for 2018 is $260. So if you're paying any parking benefits that are in excess of that amount, those are going to need to be reported as taxable compensation to the employee. So that is definitely something to be aware of. As far as reserved spots go, a lot of our credit unions we work with do have reserved spots, and the cost of those reserved parking spots are always included in UBI as well. You do have the option, to remove those signs to eliminate the UBI. So if you choose that you had these reserved spots, you no longer want to treat them as reserved, you can do that to get rid of that requirement. But those reserved spots do cause some issues related to UBI. As far as the remaining spots, so you've taken a look at your lease spots, your reserved spots, now you're looking at everything else. If after you remove any reserved spots, more than 50% of the remaining spaces are to provide parking to the general public meaning not employees of the credit union, then all of the costs of the remaining spaces are excluded from the taxable transportation fringe benefits and UBI. So you'll want to take a look at that, and if you meet that requirement, then you do not need to report this parking fringe benefit. So I know that that's a lot of information on parking, but CLA does have some really good templates that can help you with these calculations to make sure that you're reporting them correctly. So feel free to reach out to your tax team or anyone here at CLA. We can provide you with these templates that will help you take a look at each of your individual parking lots and determine whether or not those would need to be reported for UBI. So we're happy to help in that area. Other big changes occurred in the area of executive compensation. One of the largest changes here was related to excise tax. Now, this is an excise tax that actually applies to both federally chartered and state chartered credit unions. So as we discussed earlier with the 990 and 990T, that was only applicable to state chartered credit unions. But this excise tax is applicable to both. And those are reported on Form 4720 Schedule N, and the due date of that filing is May 15th. The calculation is done annually based on the compensation paid each year. So it is possible that you would not fall under excise tax rules in one year, but could in another year. So it's something you'll want to take a look at least annually, to make sure that your filings are correct. So the excise tax itself is a 21% tax, It's applied to compensation that's in excess of $1 million paid to covered employees. So those covered employees would include your CEO, your CFO, the next highest paid 3 individuals, and any prior covered employees. And you'll want to make sure you're including it when you're determining that number, the commissions and bonuses, and also deferred compensation. That's an area we see that sometimes is throwing some of our credit unions into excise tax. But if you have those non-qualified deferred compensation where there is no substantial risk of forfeiture, those need to be included as well. And so overall, this whole excise tax is very similar to the public company rules that started in 2018. So again, you'll want to watch for this from year to year, because if you do reach that $1 million threshold, you will have an additional filing and excise tax that will need to be paid. Another item to watch for is the golden parachute payments. And these are 21% excise tax also. And those payments would be taxed if they're in excess of 3 times of the individual's average salary for the past 5 years. And if the employee's paid over $120,000. So that is another area with those golden parachute payments where you can be thrown into this excise tax. And that tends to be triggered on a change in control event such as a merger. So there may be a merger that happens and then these payments occur. And if they meet that threshold, they can fall under excise tax. Again, similarly to what we just discussed, you will also want to include deferred compensation, bonuses, and most other compensation when you're looking at this calculation also. So overall, that's a quick summary of some of the recent tax changes that have affected our credit unions. Hopefully you learned something from this presentation, but my information is on the screen now. If you have any further questions, feel free to reach out to myself or any of your other CLA team members, and we'll be happy to help you out. Thanks so much for watching. Bye-bye.